Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, AI stocks are getting crushed and it's rattling investors once again. Oracle and Broadcom just reignited bubble fears despite strong growth in their earnings. I'm going to show you why this is not the start of a new stock market crash, but the kind of fear-driven sell-off that creates a once-in-a-lifetime opportunity, along with the 5 stocks I'm buying on this dip. Stick around and I'll also share news on shares of Amazon, ticker AMZN, Supermicrocomputer, SMCI, and update our stock market outlook. But first, on to that main topic, because AI stocks are selling off again even as the overall market flirts with new all-time highs. Shares of Oracle, ticker ORCL, and Broadcom, AVGO, both fell more than 10% on their earnings reports, dragging the rest of the group down with them and reigniting fears of a crash. Broadcom, selling its accelerator hardware and networking solutions into the AI data center theme, reported strong 28% revenue growth to $18 billion, more than $500 million above expectations, and earnings of $1.95 per share, which were also above forecasts. CEO Tan said he expects AI chip sales to double in the current quarter from last year, and the company reported a $73 billion backlog of orders over the next 18 months. Those shares were initially up as much as 5% in the after hours Thursday, but then plunged 10% on Friday as investor fear over that AI bubble came back. This was a very strong earnings report, though, but along with those fears related to other stocks like Oracle, investors were just worried about overexposure to a few names. For Broadcom, it's the fact that $21 billion of that $73 billion backlog is from one customer, Anthropic. Broadcom and other servicers in this space are taking on more debt to fulfill those contracted backlog of orders. But if a big single deal like Anthropic were to back out, it could leave the company with a mountain of debt and revenue that is much lower than expected. The story was similar with Oracle, though earnings were not quite as good. The cloud computing provider reported revenue just over $16 billion, which fell short of estimates for $16.2 billion, even if earnings per share did beat forecasts. With Oracle, it's a problem of debt and cash flow. Management showed off a 400% boom in revenue backlog for AI cloud services to $523 billion. But what investors saw was the $50 billion a year the company is going to have to spend to build out those data centers to deliver those cloud services. This is why looking at the cash flow statement is so important. Oracle booked just $22 billion in operational cash flow over the last year, which means all this capital investment, this spending, is taking it deeply into negative free cash flow territory, with negative $10 billion in free cash flow just in the last 3 months. So here, to pay for all of this, Oracle is expected to borrow $20 to $30 billion a year for several years, ballooning its balance sheet with tens of billions in debt, on top of the $100 billion it already owes. Further here, $300 billion of that $523 billion backlog of orders is from one customer, just OpenAI. The ChatGPT parent has contracted to pay over $1 trillion to hardware and services companies like Oracle over the next 5 years, somehow from a $10 billion in revenue this year and much less in actual operating cash flow. So the fear striking AI stocks over the last week is that to build out these massive data center infrastructure needed, the companies are borrowing hundreds of billions of dollars now, but that uncertainty is building as to whether they'll actually get paid all that promised backlog revenue deals. If the use cases for AI don't come through for the major models like GPT, Anthropic, or Gemini, there is no way in hell they're going to be able to meet those cloud services payments, and it would bring the whole house of cards tumbling down. And while the major indexes are only slightly off all-time highs, with the S&P 500 off its peak by less than 0.5%, the AI-focused ETFs are down much more. The Global X AI and Technology Fund, ticker AIQ, fell almost 2% last week, while the Robotics and Artificial Intelligence ETF, the BOTZ, is now down almost 4% from its peak. Even more focused, the Wedbush AI Revolution ETF, the ticker IVES, is down almost 7% from its high. I highlighted Dan Ives' top 10 tech stock picks for 2026 in an update 2 weeks ago, and the 30 stocks in the fund are a great starting point for ideas in that theme. I'll link to that video in the description for my full analysis, so check that out. But Nation, while the fear around the debt and the backlog revenue is coming in a little more focused this time, I still say this is nothing more than a correction that we get pretty much every year and the dip buying opportunity. We see corrections, those small sell offs, from 5 to 10% nearly every year, sometimes more than once a year, when investors just get skittish and start taking profits. We've had a correction of less than 10% in 26 of the last 45 years, each of them avoiding a bigger drop and seeing stocks rally after that. So, yes, the spending on this AI theme is at a level that we haven't seen since the dot-com, but this is a revolutionary tech, and all signs still point to that growth that's going to justify this spending. Nvidia just reported 65% sales growth in its chips and expects $500 billion in orders, flat out rejecting the AI bubble. Google's AI infrastructure boss last month told staff the company needs to double its cloud services capacity every 6 months just to keep up with demand. Even in the Broadcom and the Oracle earnings that brought this all back last week, sales growth was very strong in the double digits, with analysts forecasting Broadcom revenue will grow by 50% this year and 31% next. Not some long-term revenue promises that may or may not be fulfilled by that backlog, but revenue this year and next. And the use cases that feed that growth are there. Stanford reports in its AI Index report that AI is becoming increasingly embedded into our everyday life. As an example, 223 AI medical devices were approved last year, almost double the number from just 3 years previous. Business is also becoming a big driver for demand growth, with 78% of companies using AI in at least one function, up from just 55% the year before. And those companies are spending almost $110 billion a year on those services. Now, I've shown this timeline for data center construction before, with lead times of 2 to 3 years minimum to satisfy the compute workloads that are exploding right now. That means the hundreds of billions of dollars in capital investment, the entire AI growth thesis, is one of at least that many years or more. We may get these brief hysteria-driven corrections, but the investment in AI growth will continue, and that's going to take these stocks higher. So just as the dip to that most recent sell-off in November 20th ended up being a buy-in opportunity, last week's sell-off is going to be the same. I realize it might not be easy sitting there as your AI stocks fall harder than the rest of the market, but investors with the guts and the confidence behind their research are going to be rewarded. We've highlighted some of my favorites to buy here before, but the stocks I'm buying on this dip continue to revolve around 5 key names. Broadcom's 12% drop on Friday brought out a little more value in the shares, and I'm taking a second look here. This has been my favorite stock for that sheer scope of touchpoints it has with AI data centers, from networking hardware, software, and accelerator chips. Broadcom has major chip deals with OpenAI, Nvidia, and AMD, along with many others in networking. Analysts expect revenue to double over this year and next, with the valuation dropping to just 17 times this year's sales on Friday's crash. Shares of Amazon, ticker AMZN, came out as one of my top picks last week in the analysis of the coming chip wars that could threaten Nvidia's dominance. I'm going to link to that video in the description as well. Make sure you check that out next on some deep research over the coming change to AI. While Amazon is only expected to grow revenue at a 12% annualized pace, that's on a giant diversification in its business segments and leadership in several. Amazon is the leader in e-commerce, cloud services, and is growing its domination in advertising and logistics. Because of the slower growth, though, shares trade for just 3.8 times on that price-to-sales basis, and extremely cheap when adjusted for that growth. Advanced Micro Devices, ticker AMD, also made that list last week, where even after a 105% run in the stock price since I started recommending it in February, it's still one of the least expensive when adjusting for its 31% revenue growth. AMD is more concentrated in chips than Amazon, but I think they surprise the market with a boost to operating profitability that takes these shares higher. And one AI stock I didn't think would get another opportunity. Shares of SoundHound AI, ticker SOUN, now down 53% from its October high. The company is the AI voice assistant leader in vehicle integration, drive-through, and customer service, already signing multi-year partnerships with White Castle, Oracle, Hyundai, and Jeep. Revenue is expected to nearly double this year and grow 37% next year to $230 million, and is trading in value territory for a stock that will be the next wave of AI. And I guess I couldn't talk about AI without an update to Supermicrocomputer, ticker SMCI. Investors were loving this one in October when it was at $60 a share, up 233% from last year's low when we started buying it, but are now second-guessing that research with the shares back down to $32 each. Listen, folks, this stock is a roller coaster and not for the weak of heart or those that haven't put in the research to know its potential. SMCI is the leader in AI server racks with 22% market share and aiming for 30% of that space. The company increased its revenue outlook in the November earnings report to $36 billion this year, growth of 65% from last. It is the pure play AI stock and is trading at ridiculously cheap levels. With a market cap, the total value of all the shares in the market at $19 billion on Friday's sell-off, the stock is trading for just 0.53 times this year's sales forecast of that $36 billion. That is less than half the average 1.3 times the shares have traded at over the last year. That ratio has been as high as 4 times price to sales over the last 2 years. As long as the AI revolution continues to play out, SMCI is going to be the best value play, and I'm going to be there to pick up more shares. I'm going to show you the stocks I'm watching this week next, including a big change to our safety stocks and our market outlook. But investors are always asking me which investing platforms I use and are surprised when I tell them I have accounts on 7 different sites. I use some for research, some for easy automated investing, and all of them I got free stocks or cash back when I opened the account. Check out the link I'll leave in the description to see a full list of the sites I use, along with special offers and freebies on each. For example, you'll get up to $1,000 in stock with a new account on SoFi. Robinhood gives you a free share, and Moomoo is going to give you up to 60 free stocks on top of an 8% yield on your savings. These are all platforms and sites that I've used and totally free to sign up and start investing, so look for that link in the description and get your free stock. Now on to the stocks I'm watching this week. Lululemon Athletica, ticker LULU, jumped 10% on its earnings after I highlighted it as a quick trade in last week's stock market update. I wanted to make sure, though, you understand, as mentioned last week, this is more of a trade than a long-term bet on the stock. Further upside could be limited as the company tries to find its new CEO and a new direction. Earnings of $2.59 a share easily beat expectations for $2.25, as I suspected they would off rock-bottom estimates. But the path forward still is not going to be easy for this company. There may be some follow-on buying as the momentum investors come back in, but I'm taking my quick 10% and I'm out until I see a strategic change in this company. Oil stocks like Chevron, ticker CVX, and Diamondback Energy, FANG, could be in for a rough 2026 on a massive glut in supply. The price of oil has sold off over the last year, but had found support around $60 a barrel, which is still cash flow positive for many of the companies in this space. I have been recommending stocks in the energy sector as relative safety and cash flow in a stock sell-off, and the sector has done okay, posting a 3% return over the past 3 months, the 4th best performing sector. But now 3 factors could be about to send oil and energy stocks much lower. First, the amount of crude in seaborne ships has surged to 1.4 billion barrels, more than 24% above that normal average. Now, much of this is that sanctioned oil from Russia, Iran, and Venezuela not supposed to be bought, but it will eventually find a buyer, and it's going to build on an already very oversupplied market. OPEC nations as well as the US drillers have increased their oil production to records this year, pushing the price of crude lower as the market worries about that demand in a slowing economy. The saving grace in all this has been China adding 290,000 barrels of oil a day to its storage, but that may not last into next year. In fact, analysts estimate that supply and demand is so bad here that if just half the 97 million barrels China had bought for its storage had hit the market, oversupply levels could have been as bad as when the price turned negative in 2020. Now, of course, some of this oversupply situation is baked into the price of oil and oil stocks, but with a still weakening global economy and the probability that China is going to slow its pace of buying into next year, I'm avoiding energy stocks for the time being. But then here, real estate stocks are getting too cheap to ignore and can take oil stocks' place for relative safety in this market. The 33 property stocks in the S&P 500 XLRE fund are up just 1/3% this year, the second worst performing sector, but have hit a bottom in valuation. Signs of a rebound can be seen in large institutional buying that has turned positive this year after 2 straight years of net selling in commercial real estate. With some markets rallying, like in New York, valuations are very attractive in real estate stocks compared to the rest of the market. The difference in price to earnings valuation between real estate stocks and that of the broader S&P 500 index is at its highest it's been in more than 25 years. And that means that not only are property names a good value, but could also protect your portfolio against further weakness in the rest of the market. The sector ETF, the XLRE, gives you exposure to all 33 real estate stocks in that index, but I also like individual names like AMT, American Tower, BXP, ticker BXP, extra space storage, EXR, and digital realty, ticker DLR. Updating our stock market outlook, it is a big week for economic data, but unfortunately won't likely change the market mood we saw last week. We're going to see late reporting of November jobs and inflation data that could keep the Fed on hold for any more market-saving rate cuts. First up, the jobs report for November, usually falling on the first Friday of the month, is released Tuesday, with expectations that the US added 50,000 jobs last month versus a surprisingly strong 119,000 jobs added in October. That 50,000 jobs, while positive, is still very low for this economy. Worse, though, is that the reported number may underestimate weakness, with Fed Chair Powell warning last week that the jobs numbers may be wrong by as much as 60,000 jobs a month. Because of how the survey is collected with businesses each month, the report is always revised, but we've seen much bigger changes this year, and rather than job growth, it looks like the US may be losing about 20,000 jobs a month since April. Now that in itself would normally increase the odds that we get some market-boosting rate cuts from the Fed, but the Consumer Price Index, the CPI measure of inflation, is likely going to keep those cuts on hold. Inflation is forecast to have taken prices up 3.1% from last year, just higher than the 3% reported in October, and still well above the Fed's target of just 2% inflation. With the members of the central bank already split on last week's rate cut, that persistently high inflation is going to put them on hold for longer. So nation, we are in a scenario of slowing economic growth and weak jobs, but still high inflation, that stagflation that has worried the market all year long. Without any new earnings this week, it means the market mood is likely to stay in the shitter where it started last week, dumping a giant turd on your portfolio. That said, I'm still watching to start loading up on this dip. Stocks rebounded almost to all-time highs from that early November sell-off, falling 5% to the 21st before starting that rebound. Now, the major indexes really aren't down that much. The S&P 500 and the Nasdaq are down less than 1% from their peak, while AI-focused stocks in the Global X Artificial Intelligence ETF, the AIQ, down about 1.5% from last week. This sell-off could take us back down to around 5% drop on the S&P 500, but we've got strong seasonal buying coming up in January, so I don't think it's going to get quite that bad. Now, it will be worse for the growth in the AI stocks though, so I would let this week play out before really buying at the dip aggressively. Check out the investing sites I use, linked in the description below, and get up to $1,000 cash back and free stocks. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.